Well, you've just gone through one of the worst first halves in decades, and we think a lot of the negatives have been discounted. We expect to see some relief in the second half. We do think inflation is going to be breaking by the September, October timeframe. Valuations are reasonable, and there are a lot of really good stocks. So the key to investing is to invest for what is likely going to happen rather than what has happened. So we would not be playing defense now. We've had a lot of the consumer staples. We've done well with them.
Hmm.
We're sellers of those, and we're redeploying that money into things that have done really poorly because the stuff that's done poorly, a lot of it's going to come back pretty nicely.
Yeah, I don't feel like when we've talked in the past that cyclicals have been, a big favorite of yours. I feel like it's been more kind of bigger, more boring names, for lack of a better
You're right.
term. Yeah. What did your portfolio look like for the front half of the year, and what made you position that way?
So we're a bottom-up manager, but we were finding opportunities in the consumer staples, and we've been selling them as the year has progressed. So we took Pepsi off the table earlier in the year. We sold some General Mills in the last few months. We sold some Kellogg recently, and we're redeploying that money into things that have really been beaten up. So I think we'd mentioned the last time, like Air Products and Starbucks. Technology has been pretty beaten down, so we think there's some pretty good places to put money there. Meta, we think is going to be a good place to be. Cisco, very good place to be. There's some select healthcare that has done poorly. The drug stocks have done well, and we've scaled back on a few of those. But companies like a Medtronic or a Zimmer have done poorly. We think their prospects are good, and they're at very low valuation. So the key is valuation, prospects over the next 6 to 12 months for the business. And if you can get both of those favorably, we think that's a really good place to be. We would not chase the first half winners.
Yeah. You sound pretty comfortable talking about how you've been selling out of a name like General Mills, which is up 5% after earnings today and almost doubling its year-to-date gain. Why should people who are taking that as a sign that staples will keep working, why do you think they are misinterpreting that?
Well, you don't want to look at what has happened. The reason that we like staples is we thought that they would do well during a difficult environment. We thought that they would be able to navigate, or they had been navigating the inflation well. They were raising prices. They were the first to get hit with logistics and inflation problems about 6 months before everybody else. So they've been doing much better with that. But the stocks have done very well. So normally they'll sell it. It's a 14 to 20 times earnings. So they're at the higher end of their valuations right now. So we think they're going to continue to be fine. But if consumer staples can go up another 5 to 10% in the next 12 months, and some of these other areas are going to be up 20 to 30%, we think you have a lot more upside. And we think what's going to happen is if the market continues to go down, and we're wrong, and the market continues to go down for the next, year or so, that consumer staples, which have held up well, are going to be the next leg to be hit.
Yeah.
We had the same thesis on the utilities about 3, 4 months ago. They had done great, but in this most recent sell-off, they gave back a lot of their gains this year. So it's not a question. You don't want to just look at something that has traditionally been a safe area. If the valuations are full, you want to take your profit.